Welcome back to Things You Should Know Accounting Edition. I noted while watching my prior video that I did not explain why we were covering the order of the financial statements like they are. These statements need to be produced in a specific order, starting with the income statement, which tracks the incoming revenue and outgoing expenditures of the company, then the statement of owner's equity, which is similar to the income statement but tracks the investment in the company and the withdrawal from the company by the owners. These investments and withdrawals are not in the course of normal business, which is why they're not on the income statement. The balance sheet is the final financial report, and it takes a snapshot of the value of the company, detailing the assets and liabilities of the company. The reason for this is certain balances from the income statement, such as the net income, are needed to be resolved and used in the statement of owner's equity. In turn, the final balance in the statement of owner's equity is used in the balance sheet. The statement of the owner's equity is a statement that shows the changes in the owner's actual equity of the company. This statement is prepared before the balance sheet is prepared so that the ending capital balance can be used for the balance sheet. Once again, let's take a look at the header, and it is 3 lines. The first is the who, Jello's Coffee Shop. The second line is the what, it's a statement of owner's equity. And the third one is the when, the month ended January 31st, 2014. Before we go any further, I'm going to add parentheses on the line items that need to be subtracted, such as expenses. This is so in the video you can clearly see what numbers are being subtracted and what numbers are being added. The first line after the header is Jello's starting capital. Notice that I've already added Jello's initial investment of $100,000 at the beginning of January 1st. The next line item we see is the net income. The net income from January, $39,000. And if we go back to the income statement, we'll see where we got it from. It was the net income. Final balance here goes to the statement of owner's equity. You slide it in there. It really looks like Jello picked a really good career field to invest in. The next lines are for the owner's additions or withdrawals from the equity by direct investment or withdrawal. Jello didn't invest anything more in the company over the $100,000, which was up at the beginning. However, Jello did have to draw out $10,000. He had to pay Larry the leg breaker for those gambling debts. After we figured out the withdrawals and investments, you'll notice there's a single line. That means these have to be added together. The resulting number is the increase in capital, which for this is $29,000. $39,000 net income for January with a $10,000 equity withdrawal so the resulting amount is the increase in capital of $29,000. You'll notice there's a single line under that $29,000. That means you have to add everything in that column together. So you have to take the $100,000 starting capital, add the $29,000 increase in capital for the month. That leaves Jello with $129,000 equity in the company. We'll outline that. And you'll notice it's double underlined, indicating that is the final balance. This ending capital balance will be used in next week's video, the balance sheet. Well, folks, that was it. It was short and sweet. Trust me, as we move along here, all the statements will become more complicated as we learn more about accounting. I'll see you next week as we review what the balance sheet is.